Yeah.
There is a broad consensus, the most broad as possible consensus, that the Stability and Growth Pact serves as an anchor of confidence in the European Union. And there is a clear sense of responsibility that the credibility of the pact that we regained through hard work during the course of the crisis needs to be preserved. And therefore we all agreed that we would stick to the rules. The growth-friendly consolidation strategy should continue, and any form of flexibility should, of course, be within the existing rules. We agreed that tax burden reducing reforms should be targeted at those components and interest groups that face the greatest challenges, which may differ, of course, across member states. Secondly, the reform measures should be properly financed and take the member states' fiscal margin of maneuver into account. They should be accompanied by reductions in non-productive public expenditure and a shift to taxes that are less detrimental to growth. The positive effects of reducing the tax burden can only materialize in well-functioning labor markets, which may require a broader set of labor market reforms. Investments will be a key issue tomorrow. The Irish colleague Michael Noonan briefly informed us of his government's intention to repay early a significant part of the IMF loans to Ireland, received in the course of its successful adjustment programme. We welcomed and complimented the considerable progress made by the Cypriot authorities. However, we understand that due to the latest amendments introduced by Parliament, there is one important pending issue in the current review. It relates to the legal framework for private debt restructuring, which is an essential part of the next steps to be taken.
We need to accelerate on structural reforms. Without real reforms effectively implemented, we will not have sustainable growth and job creations. No country is immune from the need to reform. Our challenge is how to use the existing economic governance framework more efficient way to support the adoption and implementation of structural reforms by member states. We must support investment, both public and private. We can work at both national but also in European levels. At national level, countries with large current account surpluses should commit to invest more. And all countries should prioritize investments in research and development and key infrastructures. At European level, the extra public resources will be mobilized should be used in particular to draw in more private investment.
I know that they are very impressed by the progress in the 5 countries that have borrowed from EFSF and ESM, so the 5 program countries. And markets are also impressed by the stronger coordination framework that we put in place over the last few years. However, there's no room for complacency, also from that side. Investors are watching carefully that the agreed rules are actually fully implemented and that structural reforms happen in all countries. On Cyprus, we are ready to disburse very soon 350 million euro. This could happen in early October, but as the chairman said, it depends on all prior actions being in place. On Greece, we disbursed 1 billion euro in the middle of August. Now there remains available 1.8 billion euro from the EFSF and another 1.8 billion from SMP profits. But of course, this will only be made available when the 5th review has been successfully concluded.
The second quarter has seen a growth stalling after 4 quarters of recovery. We still think the recovery will proceed at a modest pace. As I said many times, the recovery is fragile, uneven, and weak, but we see it continuing. Thank you. To see investment return, we need more ambitious structural reforms. And this was by and large touched by all the speakers with the universal agreement. And against the urgent need for more structural reforms, countries should address the European Union 2014 country-specific recommendations in a determined manner. This is very important because no matter what the monetary and even fiscal stimulus is being decided, we won't see much growth coming from these measures only if there are no serious structural reforms.